Hello guys, this is Labib and you are watching the videos on the Labib's info zone. So in this channel you can find lots of videos like for research purposes, for educational purposes. So you can use this um, as your for research or for if you want any information, so you can collect from this kind of videos. You can find lots of videos like um, as for medical purpose or the insurance research or insurance on USA mainly, and the geological information, geography, etc. And all of them are for the educational purpose you can find from there. So my today's topic is um, long-term property insurance in the USA. So let's begin. So first of all, I want to read out an introduction for the property insurance. It is well known that insurance costs increase significantly following large-scale natural disasters such as major hurricanes and earthquakes. In the aftermath of the seven major hurricanes that made landfall in the United States in 2004-2005, the average homeowner's premium in the state of Florida for the doubled from $723 at the start of 2002 to $1465 in the first quarter of 2007, clean 2009. In total, areas insured were permitted by regulations to triple, even quadruple the premiums for some homeowners. While the market price of insurance has significantly increased in the coastal areas, like insurance are still concerned that their long-term earnings will be negatively impacted. So February 2007, State Farm, the largest home insurance in Mississippi, stopped selling new policies on homes and small businesses there. Tristar 2007 listed. Another giant provider of residential insurance announced it would restrict new homeowners policies in New Jersey, Connecticut, Delaware, and New York City. In January 2009, State Farm announced that it would pull out at Florida's insurance market over the next 2 years unless it was granted a significant increase in its homeowners' premium by the insurance and regulator. The insurance company which stopped writing new homeowners' premium by the insurance regulator. The insurance company which stopped writing new homeowners policy in Florida in 2008. So from this part we can find out that in that particular era the property insurance was not at its good state. Following catastrophe, residents often wonder why insurance companies increase their rates so dramatically from one year to the next. Given in the expertise in the quantifying risk, many are also concerned as to whether they will have access to insurance coverage against this risk in the future. This uncertainty in the part of homeowners suggests that following uh, questions: how can the cost of coverage be smoothed over time to avoid the radical changes in the insurance markets from year to year? To address the question, we need to find ways to reduce insurance earning volatility while assuring these residing in high risk areas that their provider will not cancel their policies. So that was their main concern, or double or triple the premiums after the disaster if the recent past in United States as shown in table 1. So the imperials regarding investments in migrating in also revealing a 1974 survey of more than 1,000 California homeowners in earthquake-prone areas revealed that only 20% of the respondents had adopted any protective measures. Homeowners for California countries at risk from earthquakes, only 5 to 9% of the respondents in these areas reported adopting any loss reduction measures. Similar reluctance by residents in flood-prone areas to invest in mitigation measures was found by Murphy 1988 and Alaska 1999. Even after hurricanes caused extensive damage to large part of the US Atlantic and Gulf coastline. During the 2004 to 2005 hurricane seasons, a large number of residents had still not invested in relatively inexpensive loss reduction measures with respect to the property, nor had they undertaken emergency preparedness measures. A survey of 100,000 adults living along the Atlantic and Gulf coasts, undertaken in May 2006, revealed that 83% of the respondents had not taken any steps to fortify their homes. 68% had no hurricane survival kit. 60% had no family disaster plan. To address the dual problem of volatility of insurance premiums and homeowners' failure to properly insure the protect their property against future damage from disaster, we propose the following modification of current contractual arrangements: provide homeowners coverage through long-term insurance LTI policies that would be attached to the property. The length of years, to our knowledge, no systematic analysis has been undertaken on the pros and cons of such multi-year insurance contracts to cover natural hazards and how their policies could be such multi-year insurance contracts to cover natural hazards and how these policies could be regulated and sold. So multi-year catastrophe insurance at that time was very effective. So from my point of view, it was a good move. To our knowledge, no systematic analysis has been undertaken on the pros and cons. Multi-year catastrophe insurance could be also a natural complement to proposal for federal natural disaster insurance plan that have been introduced in Congress in recent years. The paper is organized as follows. Following a discussion on the need for LTI, we developed a simple two-period model to capture key features in designing an LTI contract and compare to the performance to one-period insurance policies. We then apply the historical lessons from the mortgage market. They evolved from 1 to 3 year contracts in the 1920 and 30-year mortgage in the market today. This case study suggests how regulatory investments can create highly valuable and long-lasting changes in the financial contract. While there are differences between mortgage and insurance, this example suggests starting with a federally regulated program in a benchmark for introducing LTI by private sector insurance. The federal nation's flood insurance program NFIP is a natural first step in making the LTI concept attractive to private insurers. The insurance of the commissioners who currently regulate premium in the 50 states. We then suggest how the NFIB could be redesigned to provide long-term insurance tied to property rather than the homeowner. The paper concludes with a brief summary and a set of issues and questions that need to be addressed for multi-year property insurance to be considered by private sector insurance. The need for long-term insurance (LTI), the property insurance for residential properties has always been provided annual contracts renewable at the option of the insurance. In some cases, legislation has restricted insurance from cancelling policies in order to assure residentials that coverage will continue to be available following the Northridge earthquake 1994. California, in effect, imposed an exit fee on insurance that no longer wished to offer earthquake coverage to homeowners by requiring these firms to provide that insurance costs. Initial capitalizing for the newly created California Earthquake Authority, California. In Florida, the occurrences of Hurricane Andrew in August 1992 led the state legislation to enact a bill in November 1993 that insurers could not cancel more than 10% for their homeowners' policies in any country in 1 year, that they could not cancel more than 5% of their property owners' policies statewide for the next 3 years. During the 1996 state legislation session, the law was extended until June 1, 1999. Florida established a state-operated assigned risk pool citizen property insurance corporations as a stopgap. Some risk pool citizens property insurance corporation. According to the state law, citizens can recoup the deficit exposed against all other private insurance in the state, when the return would have to surcharge against all their policyholders. Given that insurance have restricted the sale homeowners coverage, psychological cannot help but worry that the existing insurance might be subject to unexpected cancellation or very significant premium increases or ex post recompense, particularly if a natural disaster creates severe damages in the near future. 1 year insurance policies impose significant costs on policyholders as well as insurers. Many individuals voluntarily purchase insurance against a given type of hazard occurs and then cancel their policies a few years later if they have not suffered another loss. The practice occurs with flood related insurance even when individuals are required to purchase overage condition over a property related considers insurance. Banks and financial institutions often fail to enforce the requirement, first because of few they ever find, and second because of their mortgages are often transferred to banks, not their secondary market. Consider the August 1998 flood and damaged property in northern Vermont. Of the 1,549 victims of this disaster, FEMA found that 84% of the homeowners in a special flood required purchase their coverage on a much broader scale. A recent study of flood insurance tenure in Florida revealed that one of the million residents NFIP flood insurance policies in place in 2000, only one-third had been recovered of that insurance. So Michael Kurgan of moreover evidence from recent disasters reveals that residents who fail to adequately protect their home and purchase insurance create a welfare cost to themselves and possibly cost to all taxpayers in the form of government disaster assistance. The dramatic increase of the numbers of US presidential disaster declaring over the past 15 years in the striking. There were 162 during the period 1955, 1965, 282 during 1966, 1975, 319 during the period of 1986, 1995, and the 545 during 1996, 2005, Michael Kurgan 2008. In response to Hurricane Katrina in 2005, Two emergency supplemental appropriations bills PL 109 to 61 and PL 109 to 62 were enacted by Congress that provide the 62.3 billion for emergency response and recovery needs. In 2006, another 19.3 billion was appropriated in supplement legislation PL 190 to 234 Penal Code. Okay, for recovery assistance in 2006 dollars taken another this 81.6 billion in federal relief is for then the combined total insurance claims that the private insurance has damaged due to wind and payments by NFIP for flood damage caused by Katrina. Multi-year insurance policy attached to the property, not to homeowner, promise to overcome these problems by stretching the time horizon by the low probability, high consequences events. One might be able to make them more silent and make insurance much more easier attractive to many than it would have shown by recent studies. An LTI insurance policy could be coordinated with long-term home improvements loans to reduce insurance premiums and to smooth the cost of the mitigation investment. This could encourage residents in disaster-prone areas to make their houses more resilient to floods, hurricanes, or other type of hazards. A simple LTI model. This section looks at the FBL's contracts that could be developed as an alternative to existing annual contracts in a competitive market where insurers are free to charge premiums that reflect risk. We briefly discuss on this matter that basic features of LTI relevant lectures like an extensive literature in economics, insurance of finance providers, into the optimal design of property insurance, financial assistance, content, the literature journalism, the specific economic decision making environment. With actions of the various agents affected by such as transaction costs and incomplete contracts and unsystematic information also specified utility. Subjected to the contract and the board of developed a simple model to demonstrate the superiority of the long-term property insurance cover one period insurance policies. Two-period model of LTI to provide the rationales for the LTI over annual contracts. Like we developed two periods model then highlights the trade-offs facing insurance and policyholders who have the options of purchase either long-term LT policy, fixed premium for each of the two periods of two one-period contracts for each of comparison to be meaningful. It is necessary that insurance premiums reflect the actual risk. So we assume a competitive market in which insurance are not like risk natural or maximizing expectations like probability of disaster of period and most of the at the end of the period of insurance consumption both learn and the probability of disaster in period 2 to provide the rational see Allen of the Gallup Bookland survey the assumption of simply the insurance the premiums are said to equal to the expected. We also believe like LT policies can be designed to be attractive for insurance. Perhaps importantly there will be lower administrations and marketing costs related to the gaming new consumer regaming older customers who have left the company associated with LT policy than the sequences of one period policies, some of these costs having the less past of the cycle holders. Any additional former motivation LTE demand on the negative side, LTE policies have created higher capital cost of if there are considerable uncertainty with respect to the loss contributions in period of. However, the additional expense can be offset and even reversed by the two factors. First, as just noted, LTE policies LT policies to be set high enough to compensate insurers for taking on additional risk. Regulatory may also be more enthusiastic toward LT policies. Are insurers agree to continue to offer one period policies, while insurers may also deal with the uncertainty of future loss distribution. So offering long-term policies with adjustable premiums. Put more generally, LT policies will expand the range of the policies that can be offered by insurance and thereby enhance regulatory flexibility with respect to risk-based premiums. Long-term insurance costs, contract length, and fixed versus adjustable premiums. There are many detailed contract design questions that need to be addressed in consultation with insurers, with regulators, but they are beyond the scope of the present paper. However, we do comment bear on two fundamental related issues: contract length and fixed versus adjustable premiums. The market for term life insurance illustrates the options concerning contract length of adjustable premiums that may offer an insurance like then be combined with alternatives for fixed versus or adjustable premiums. In the extreme, and fixed premium can be set for the contract issuers. Schedule is specific in the contract since the premiums are adjustment to the policyholder's age in predetermined manner. The actual frequency of the premium changes in generally of secondary importance instead of the fundamental issues and concept. The term over which the contract holders independent of any changes in the insurance medical condition. The market of term life insurance illustrate. We now apply those coincidences and considerations to catastrophe using flood insurance as our example. If the premium is fixed over the contract length, then the policy offers benefit that the comparable to the life insurance to the policy just discussed. However, adjustable premium affects flood insurance very difficult than the life insurance. For example, premium changes and the development. So we now apply these considerations of catastrophe considerations insurance using flood insurance as the property insurance as our example. So if the premium fixed over the contract length, then the policy offers benefits hit the comparably to the life insurance policy just discussed. For life insurance, premium changes primarily depend on the age of insured. For flood insurance, premium would like to change, and adjustable premium flood insurance policy would have to continue formula indicating now premiums would change as a result of a new information with respect to the nature of the risk. Regulatory permissions to the offer such as LTI policy would record that specific factors were external ones true so that they could be manipulated by the insurance offer for any stakeholder. The adjustable premium contract would need to be transparent and understandable stakeholders. To prospective policyholders, consumers would then choose from a menu of fixed and adjustable premiums. The fixed premiums are period for an LT policy given by 2 would be J and bracket in the LT equal to 21, so that the total premiums over the two periods would be 42, identical to the expected premium for two 1 period contracts. And cancellation cost if a policyholder decide to cancel this LT insurance after period 1 would be C equal to 11 as determined by question. If there are no administrative search or transaction cost in the insurance policies market, then the national policyholders would always want to buy an LT policy if He was risk averse since his premium is stable over time. He would be indifferent to cancelling his LT policy after period 1 if the probability of a loss in period 2 was determined to be P20L. Social welfare implications. Based on the two-period model, one can determine the social welfare implications of providing long-term insurance LT insurance contracts to the consumers in a manner similar. Most homeowner policies are adjust premiums based on changes if the value of the insured structure in order to keep the amount of insurance approximately. So, in the insurance markets, although Arrow's papers are written in the context of the market failure for the medical insurance, it is remarkable that almost all the points apply today to similar market failure with respect to the provisions to the coverage against catastrophic losses. For example, Arrow's discussion focuses on which issues is the last welfare loss than insurance market of contractor are incomplete. When there are such costs and administrative costs, when there can be high variability in the risk level, and when there is informational amenity or moral hazard. He also emphasized the welfare loss that occurs when the absence of the insurance market causes individuals to pursue activities that they would otherwise pursue. He also mentions are benefits of the insurance with a longer time perspective that might have level premiums as illustrated by the life insurance as noted in the previous sections that I have already discussed about that. So my key questions, and guys your key questions. LD is of course how to provide imputed so that it will actually be implemented in a Pareto efficiency manner so that everybody's welfare is improved. We take up the issues the remainder of the paper. We start in the next section with a brief review of how US mortgages achieved an incomparable transition from short-term to long-term contracts during the 1930s. As we will see, government interventions and regulations were essential for the innovations of occur. While there are of course important differences between mortgages and insurance. As discussed in the introduction, the evolution of the mortgage market provides an interesting benchmark for the consideration the role of the regulations can play. The introduction for long-term insurance, it also worth noting that although the recent performance dismissal a benchmark for LDI lessons from the mortgage markets until the Great Depression of long-term 20-30-year maturity mortgages were rare in United States. American bank mortgages were commonly short-term maturities of 4 years when the full principal due to maturity of the arrangements were well because in practice the long-term regulatory on the each maturity date. However, as the Great Depression took hold, dispositive fail left the bank no choices but to recur full requirement as each mortgage matured. So in 1993, the federal, however, had to default the bank sales of the prosperities added to the collapse. Houses price that already be occurring. Jeffy and in 1993, federal government intervened to curtail this process. The federal home owners loan properties of all was created that were to modify the failing home mortgages, anticipating the entry of the HPHA, and the entry of the BHA greatly facilitated the long-term mortgage of innovation. It was plausible that the action of the HOLC of the FHA hastened the standardization of long-term achieved in the owned and archived heavily. The long-term FHA mortgages were also the basis of creating the Government National Mortgage Association, that the short term is GNMA. mortgage-backed security (MBS) in 1968, the first MBS to be widely traded in the United States. Both are FHA mortgages and the GNMA MBS have also had the full faith backing of the US Treasury and either contributed to the subprime crisis. Indeed, both programs are now the center of government policies to stabilize the US mortgage facilities in the market of the collaboration. The history of the FHA program provides a very useful template for the role that government and regulators can play in the creation of a new long-term insurance market. First, it illustrates that in the absence of the coordination of the provide GNM MBS market, JFE and quellingly further suggests that the FHA program was instrumental in allowing the refreshment of private mortgage of insurance industry starting in 1956. Since the success of FHA program demonstrated that it was feasible to insure long-term mortgages. More generally, the later development of the private mortgage insurance in industry and the private market of mortgages further indicate that a government program such as the FHA will not crowd out private competitors. A key factor here is that the FHA is required to set actuarially of fair insurance premiums. In other words, its premium should reflect the risk of related factor was the willingness of the FHA to cede to private mortgage lenders, and the insurance are primary responsibility for later mortgage contract innovations that are adjustable rate percentages of mortgages. A pilot program. So here comes the pilot program for long-term flood insurance, which is called NFIP. In the section, we propose using the National Flood Insurance Program (NFIP) as the starting point for the implementation of long-term property insurance in much the same way that the FHA simulated the innovation of long-term mortgage. A key insurance of focusing on federal flood insurance as the starting point for the LDI innovation is the new program is already being considerable and considered for the major regulatory reforms. See that by way of background of NFIP was created in 1985. So it's the main point that when the NFIP was created, the year is 1968, 1975 because insurers viewed flood risk as unusable and refused to cover it. As of December 2008, NFIP sold over 5.5 million policies annually compared to 2.5 million in 1992. So you can find the gap here very specifically and cover nearly 1.2 trillion. I'm saying again, that's covered nearly 1.2 trillion in assets, so compared to the only 237 billion in 1992. That's huge actually. How an LTI program would work? We propose that the NFIP move to 5 to 10 or even 20-year flood insurance contracts attached directly to the property rather than to the homeowner. If a homeowner moved to another location, the flood insurance policy would remain with the property. One might also consider requiring everyone in flood-prone areas to take out the insurance just as the dollar coverage for a specified period of time. If the homeowner sold his or her property before the end of the policy period, then the insurance policy would automatically be transferred to the new owner at the same rate. The NFIP is managed under the Federal Emergency Management Agency (FEMA), U.S. Department of Homeland Security, which determines insurance premiums nationally. This makes these regulations of long-term flood insurance much easier than having to deal with 50 different state regulatory system. As in the case of homeowners insurance today, the NFIP would set their premiums. For LTI, the policies would be offered in the form of fixed price contract FPC. So you can say that actually for that full term of policy for adjustable premium contract ABC with guaranteed renewal for the term of policy, APC premiums would likely to be somewhat higher than APC premiums to protect the NFIP against an increase to the risk of relatability. Adjustable rate mortgages for APC, it is critical that the premium of variation be based on an external and transparent index comparable to the similar and the pricing against the rate mortgages or relatively adjustable rate mortgages for APC. It is critical that the premium variations be based on an external and transparent index comparable to the treasury bill rate used for adjustable rate mortgages. There may also have to be caps on how much the premium can change year to 10 year, just as there are limits on how much our interest rate and payment amounts can change annually on adjustable rate mortgages arms. The NFIP could be an integrated with loan plan to the finance home improvement projects that would make insured properties more resilient to the future floods. As discussed earlier, to the combination of long-term flood insurance and long-term loans for reducing future flood. So okay. Losses and promises to improve both individual and social welfare. 1-year insurance policies impose a significant cost of policyholders as well as insurance. Many individuals voluntarily purchase insurance, and the most note for the distinction. Consider the August 1998 flood that the damaged property in northern Vermont of the 1,549 victims of the disaster. FEMA found that 84% of the homeowners in the special flood hazard areas did not have insurance, even though 45% of these individuals were required to purchase this coverage. Tobin and Kelfe in 2005. On a much broader scale, a recent study of flood insurance tenure in Florida revealed that the 1 million residential NFIP flood insurance policies are in place of 2000. Only 1/3 had been renewed by 2005. Moreover, evidence from recent disaster reveals that the residents who fail to adequately protect their properties insurance creates a welfare cost to themselves and possible cost to all taxpayers in the form of government disaster assistance. Multi-year insurance or policy attached to the property, not to the homeowner, promises to overcome these problems by stretching the time horizon for low probability high consequences events on the might be able to make them adequately. Multi-year insurance policies attached to the property, not to homeowner, promise to overcome these problems by stretching the time horizon for low probability high consequences events. One might be able to make them more silent and make insurance much more attractive to them. Of the hurricanes or other type of hazards, the benefits from such investments could be significant, that there will be less damage to the property due to a reduction in the gross losses of natural disasters. Insurance lines more secure mortgages and lower costs to the government for disaster assistance. A simple LTI model. The section looks at the type of LTI contracts that could be developed as an alternative to existing annual contracts in a competitive market. Their insurers are free to charge premiums that could reflect risk. We briefly discuss the relevant literature and then propose a simple two-period model captures the basic features of LTI. Relevant literature. As extensive literature and in economics, insurance and finance Develop provides insight into the optimal design of financial securities and contracts over the properties of the home properties owners and the flood affected people. The literature generally assumes a specific economic decisions, consumptions, and the where consumers are assumed and maximizing their losses and the disasters. We have intentionally developed a simple model to the insurance and the demonstrate the superiority of the long-term contract over one-period insurance policies. A two-period model for LDI. Two-period the rationale for the LDI over annual contracts. We develop a two-periods model that highlights the trade-offs facing issuers and policyholders who have the option to purchase either a long-term LD policy and the fixed premium for each of the two periods or two one-period contracts. For such a comparison to be meaningful, it is unnecessary that insurance premiums reflect the actual risk. Assumptions. We assume a competitive market in which issuers are homogeneous, risk neutral, and maximizing expected profits. At first, we put aside marketing or research cost of insurance and the policy of the when the probability of disaster in period 2 or H or L noted P2H and P2L repeatedly. Notation the insurance premium in period 1 or 1 period policy and determined at the beginning of period and the fixed insurance premium per period to LD coverage determined in the beginning of period and the insured damage of disaster occurs. Probability of D in period 1, high probability D in period 2, low probability D in period 2. Weight placed by experts in period 1 and likelihood of P2L in period 2 with therefore penalty and the P1D, 1A and H2 premium charged by the insurance. Okay. We also believe LD policies can be designed to be attractive for insurers. Perhaps most importantly, there will be lower administrative and marketing costs related to gaming the new consumers and regaming olders. One with policies, some of this cost saving will have passed on to policyholders. And additional factors that the LD policies will have lower administrative and marketing costs. Second, insurers may be able to achieve greater flexibility and pricing by introducing LD policies. Long-term insurance contract length and fixed versus adjustable primaries. There are many detailed contract design questions that need to be addressed in consultation with insurers and regulators, but they are beyond the scope and present paper. However, we do comment here on two fundamental related issues: contract high length and fixed versus adjustable premiums. The market for term life insurance illustrates the options concerning the contract length and adjustable premiums that may be offered in insurance market. For life insurance, the contract length determines the span of time over which the insurance is willing to provide protection for periods as short as one of the long until death. Longer term policies can then be premium can be set for the entire contract. The cancellation by policyholders is gain for the insured. In practice, it is common for insurers to offer contracts that combine a degree of guaranteed renewability with premium that adjust at determined interval, often over 5 years, according to a schedule specified in the contract. Since the premiums are adjusting to the policyholder's age in predetermined manner, the actual frequency of the premium changes is generally of secondary importance instead of fundamental issues. Concerns the term over which the contract holders independent of any changes in the insured medical conditions. We now apply these considerations to the catastrophe insurance using flood insurance as our example. If the premium is fixed over the length, then the policy offers could benefits that the comparably to the file and independence of the record. So an illustrative example. So now I want to talk about the social social welfare implements. Okay, the based on two periods model, one can determine the social welfare implements of providing long-term property insurance and LT insurance contracts to consumers in a manner similar analysis undertaken by Arrow 1963 in his path-breaking study of the welfare benefits of the insurance markets. Although Arrow's paper is written in the context of the market failure for medical insurance, it is remarkable that almost all the points applied today is to similar market failure with respect to the provisions of the coverage against catastrophic losses. For example, contracts are incomplete then where there are such costs of administrative costs, and then there can be high variability in the risk level, and then there are informational amnesty of moral hazard. He also emphasized the welfare loss that occurs when the absence of insurance markets causes individuals of forgery activities that could also otherwise the pursue. He also mentions that the benefits of insurance with a longer time perspective that might have level premiums as illustrated by life insurance. As noted that the previous section, LDI can coverage who are myopic in the thinking that invest in cost effective mitigation measures. To illustrate the point in the context of the above examples, suppose that a person can invest in a cost effective mitigation measures at an upfront cost of M15 that it would reduce losses to 45. It premiums reflected risk, then the reduced premiums in period 1 would be 9 and expected reduced premium in period 2 would be 9.9. Those individuals who were myopic in considering well the benefits in the next period would not invest in the mitigation measures. An insurer who marked a 2-period LT policy might also be the natural lender to provide a 2-period loan to cover the cost of the mitigation measures. To be clear, issued individuals will have a financial incentive to invest in the mitigation measures only if the investment cost is less than a present value of the reduction is the insurance premium. For this to be true, it is essential that the insurgence of premium to be risk based and therefore reduced to reflect the lower expected loss if the mitigation investment is made over. Oh, that is a key question of LTI. Of course, how to provide an exam impetus so that it will be actually implemented on the US regulations. Right. The benchmark of LTI lessons from mortgages of market until the Great Depression of long-term maturity mortgages were rare in the United States. American bank mortgages were commonly short-term matured on the period. Reduction to the expected loss in period 1 is the period of the likelihood of a low and a high probability. Many borrowers had to default to the bank, and sales of the properties added to the collapse of house prices that are already occurring under the dire depression conditions. A various circular ensured of falling house prices begot more mortgages, and the difficulty of mortgages of the history of the FHA program provides a very useful template for the role that government and regulations can play in the creations of a new long-term insurance market. First, it illustrates that in the regulatory can play in the creation of the long-term insurance market. First, it illustrates that in the absence of coordination, private market may fail in initiating importantly financial innovations. That the government's intervention was not only the value of its own sake, but it provided the variety of external benefits, including in the GNMA MBS market. Jeffrey and Coinley further suggests that the FHA program was instrumental in allowing the reestablishment of a private mortgage insurance industry starting in 1956. Since the success of the FHA program demonstrated that it was feasible to insure long-term home mortgages. More generally, the later development of the private mortgage insurance industry, the private market of mortgage further indicate that the government programs such as FHA will not crowd private competitors. A key factor here is that the FHA is required to set accurately fair insurance premiums. In other words, its premiums should reflect the risk. A related factor was the willingness of the FHA to CEDE and the private mortgage lender that ensures the primarily responsibility for later mortgage and contract. The innovations of the such as adjustable rate mortgages. How an LDI program would works. I got these questions from many people, so now I want to explain that how LTI program would work. So the US Insurance Authority proposed that the NFIP move to 5 to 10 or even 20 to 20-year flood insurance contracts attached directly to the property rather than rather than to be the homeowner. If a homeowner moved to another location, the flood insurance policy would remain with the property. One might also consider requiring everyone in the flood prone areas to take out the insurance, just as those who own a car are required to take out automobile insurance. A long-term flood insurance program would offer homeowners currently residing in flood-prone areas a fixed premium per dollar coverage for a specified period of time. If the homeowner sold his or her property before the end of the policy period, then the insurance policy would automatically be transferred to the new owner the same date. The NFIP is managed under the Federal Emergency Management Agency (FEMA), US Department of Homeland, which determines insurance premiums nationally. This makes the regulation of a long-term flood insurance much easier than having a deal with 50 different state regulatory systems. As in the case of homeowners insurance today, the NFIP would set these premiums for LTI and policies would be offered in the form of fixed price contract (FPC) for the full term of the policy and adjustable premium contract (APC) with regulated of the APC. It's critical that's the premium variations. Adjustable rate mortgages, there may be also have to caps on how much the premium can charge year to year, just as there are limits on how much our interest rate and payments amounts can change annually on adjustable repayment mortgages arms. The NFIP could also be integrated with a loan plan to finance home improvement projects, would make insured properties more resilient or to future floods. As discussed earlier, the combinations of long-term flood insurance and long-term loans for the reducing future floods. So the losses and the promises to improve both individual and the social welfare from the perspective of the relevant stakeholders, homeowners, FEMA, the bank, the money provider institutions, the loaners institutions, investment companies, financial institutions, and the taxpayers. There are a number of reasons why such a long-term flood insurance policy attached to the property would be a great improvement over annual policies. Flood insurance premium set as a fixed price per dollar coverage would provide the homeowners with financial stability. Long-term flood insurance would also ensure the spread of risk within the program. Since many flood policies are held for just a few years, Michael Carson was forthcoming. If the flood insurance were required for all properties located in the hazard zone prone areas, then there would be even greater risk spreading. This time of requirement would provide much needed financial revenue for the program over time because it would create a such larger policy base than is currently available. Homeowners would have no concern for the financial solvency of their insurance since the NFIP has the continuing backstop with the US Treasury, another parallel to the FHA mortgage and agency. Summary and future research questions. Insurance of costs fluctuates significantly after catastrophe causing residents in exposed areas, certainly as how much they will have to pay for the coverage from the one year to the next. Furthermore, many residents in exposed areas do not purchase significant insurance and thus require federal relief when hurricanes or major flooding occurs. To address these issues, the proper purposes of the development of long-term insurance (LTI) either fixed to variable premiums that would be attached to the property, not the based on the history of the mortgage mark. We adjust that the federal government can play an important role in the facilitating the development of a long-term private insurance market. Homeowners coverage by offering multi-year flood insurance policies tied to the property through a modification of the National Flood Insurance Program. There are actually several important questions related to the development of LTI market that not be answered yet. LTI market that need to be analyzed further. Should one want private insurance to sell long-term property insurance as well? They included the following issues: that the premium setting, the premium rate setting, the percentage of the financial institutions like the bank, the investment institutions like the federal government or the local government or the state government, risk index, whether the LTI contract use fixed or adjustable premiums. One of the challenge will not be establishing a transparent mode of evaluating risk exposure for the period of the cover in the context. What is an appropriate risk index to price an adjustable premium contract? That would be the most legitimate organization to calculate in the public that index. Okay. And the insurance regulation, how will LTI will be work regulated by the risk factors, the consider about the risk factor for an LTI policy to the feasible for the private insurers. The premium needs to be high risk and cover all administrative costs and make this a profit. Today, due to political pressure, how homeowners insurance prices are frequently restricted by state regulators to the artificially low in hazard prone areas. The result is that the risk most subject to catastrophic losses also become the most unattractive the issuers to the market. Rating agencies, how will rating agencies that LTI policies could, how much capital would they require? Insurance that hold to protect policyholders against loss during the term of the contract. In the aim, so I can also tell that the creating long-term insurance that will be attractive to the insurance homeowners, regulators, and other relevant stakeholders depends on the market of conditions that are associated with the new instrument. What is clear, however, it is that we need to be innovative our programs and involve the combined strength of the public and private sectors of reducing future losses from the disasters. It's simple as that. So if you want to some references like the Aaron Henry 1978, 1972 shelters and subsidies, who benefit the federal housing policies, the brookings of institution Washington DC, Alan Franklin and Douglas Gale 1994 financial innovations and risk sharing MIT Press, American Public Power Association 2009 public power utilities in energy efficiency loan and rebate programs available at Arrow Kenneth and uncertainty, the welfare economics of medical care, American economics and review, Boland, Kaiser review, the model of the John R. Schaefer. Cities underwater, a comparative regulations 10 cities afford the manage of the floodplain land and the regulations of the Federal Housing Administration working paper none of the Act. Carmen. Okay, so the owner of the American Academic Policies and the Social Accounts of 2016 Ford and the author of the Harvard Robert J. Mayer and Worm forthcoming overcoming decisions. Lecomet, Egon, and Karen Gagan of 1998. So these are all the references you can find. And the Hurricane Insurance Protection in Florida in Kardankar and the Courts Houses Committee of the Budget of the Risk of that fractional. And the Government of Accountability Officers and so today actually I wanted to explain uh, like the short course of I mean the short introduction, like kind of, or the short explanation of the home property of the US, I mean the US actions, and this is mainly in the Florida. Okay, so I hope you guys actually enjoyed my video, and you can find a lots of information from my video. So stay tuned and don't forget to subscribe my channel. You can subscribe my channel and share with your friends. Your share will be also benefited from this kind of videos. So that's all for today. Take care of yourself.